Welcome to the Deep Dive, the only place where we turn massive stacks of research into actionable, unforgettable knowledge. Today, we are undertaking a critical mission. We're trying to understand what looks like a profound mispricing in the world of genomic medicine. We are diving into Prime Medicine, Inc., ticker PRME.
And it really is one of the most, frustrating puzzles in biotech right now. I mean, here you have a company that holds the proprietary claim to arguably the most versatile and safest gene editing technology developed to date. Some people are calling it the genomic word processor.
Right, and they've got validated human data from their early pipeline. They have this massive, multi-billion-dollar financial anchor with a partner like Bristol-Myers Squibb.
Exactly. And yet,
And yet the stock is trading like it's facing immediate bankruptcy. Our sources show the price sitting right around $3.72. That's barely above their cash value per share.
barely. Meanwhile, you've got analysts who, have done their own deep dives. They see a target of 750.
That is a massive, almost 100% disconnect.
It just screams of market skepticism. I think it's, high interest rate jitters and a really negative interpretation of what was probably a necessary strategic decision.
And that's our mission today. We're going to unpack all the research to figure out if the market has profoundly mispriced this asset. We're going to focus specifically on that critical strategic pivot they made back in May of 2025 and the immediate high-value promise of their new focused liver pipeline.
And we're going to show you that despite the inherent high risk in this industry, the strong internal signals, I'm talking about massive insider buying at these depressed levels, it suggests this stock presents a really asymmetric opportunity.
So the downside is partially insulated by the cash on the balance sheet.
Right, but the upside potential is tied to them successfully executing in 2026. This whole setup provides a crucial margin of safety for the patient investor.
Okay, let's start at the beginning. We have to understand the technology itself, the moat they've built. Part 1, chapters 1 to 3, Business, Management, and Financials. Chapter 1, Business Understanding.
So to really appreciate the potential valuation here, you have to first understand the fundamental technological advantage, what we're calling the genomic word processor. The core proprietary tech is called prime editing, or PE.
And that word processor analogy, it works perfectly, doesn't it? It immediately frames prime editing as this huge upgrade over older technologies like first-gen CRISPR. You're basically moving from a pair of scissors to the find and replace function on your computer.
That is exactly right. Think of the original CRISPR-Cas9 system. It's an incredibly powerful tool, but it works by causing what's called a double-strand break, a DSB, in the DNA helix.
Which is like, as you said, cutting a sentence in a book with scissors and just hoping the cell glues it back together the right way.
Exactly, and maybe adds a new word in the process. Prime editing is fundamentally different. It uses a fusion protein, guided by a specialized RNA, to precisely nick only one strand. And then it uses an enzyme, a reverse transcriptase, to rewrite the code accurately without ever severing the entire helix.
And that difference, avoiding the DSB, the double-strand break, that's the absolute key to their commercial potential, to their moat, right? It solves the biggest safety hurdle these companies face.
It is the central pillar of their entire safety argument. And that translates directly into a tangible commercial asset. You see, when you introduce a DSB, you risk these large, unintended DNA deletions and, even worse, something called chromosomal translocations.
Where big chunks of genetic material just jump to the wrong chromosome.
Catastrophic events. And as we move into later stage trials and regulators like the FDA get more and more strict about the long-term safety of these medicines, Prime's approach just looks dramatically de-risked compared to platforms still relying on those DSBs.
And this isn't just a theory, right? You mentioned there's actual research out there confirming this safety advantage.
Yes, and this is a critical data point that I think the market is just completely ignoring. Sources are citing research published in Nature Biomedical Engineering in late 2025. This research confirmed that large DNA deletions, which are the specific safety concern we really worry about, they occur at a roughly 20-fold lower frequency when you're using prime editors compared to standard CRISPR-Cas9.
Okay, let's just pause on that for a second. 20-fold. A 20x improvement in safety isn't just a win for the scientists. How does that practically change the game for drug development, for regulatory approval?
It fundamentally alters the entire financial risk profile. I mean, first, just think about clinical trial design. If you have a technology with known low off-target effects, you might be able to justify higher doses in your trials, which could accelerate efficacy and widen your therapeutic window.
Okay, that makes sense.
But second, and this is probably the most important part, is the regulatory landscape. Regulators know DSBs are risky. If you can walk into the FDA and present data showing your therapeutic platform inherently carries 20 times less risk of these catastrophic events than your competitors, well, you're immediately lowering that regulatory hurdle.
Which means faster approvals, lower costs.
Faster approval timelines, and you reduce the costs associated with all those lengthy toxicology studies focused on these off-target effects. It's an efficiency and a safety dividend all bundled into one technology.
And beyond safety, there's this incredible issue of versatility. I mean, gene editing is useless if it can only fix a few niche problems.
And the versatility is what really sets them apart as the word processor. I mean, consider base editing. It's another next-gen technology, and it's brilliant, but it's limited mostly to point mutations.
Changing one letter to another letter?
Right, a C to a T or an A to a G. It can't really handle insertions or deletions. And CRISPR is typically best for just knocking out or disrupting a faulty gene entirely. But prime editing, because of its search and replace mechanism, can correct virtually all types of genetic errors.
So we're talking about substituting one base for another. We're talking about inserting missing bases or deleting ones that shouldn't be there.
Precisely. All 12 possible single-base substitutions, plus insertions and deletions of varying sizes.
Right.
When you tally up all the known genetic typos that cause human disease, the research shows that prime editing can correct about 90% of all known pathogenic mutations.
90%.
90%. That level of therapeutic scope is just unmatched. It instantly makes prime the preferred platform for fixing a huge range of diseases.
But prime medicine isn't just relying on fixing small typos. They can also insert entire large healthy genes. That's where the PASSAGE platform comes in, which you called the genetic superglue.
That's right. PASSAGE, or Prime-Assisted Site-Specific Integrase Gene Editing, is designed to solve what's called the cargo problem. This is the technical challenge of inserting a large genetic payload, maybe an entire therapeutic gene, into a very specific, safe location in the patient's genome.
And why is that distinction so crucial, especially when we think about their biggest partnership?
Because it completely diversifies their business model. It opens up entirely different therapeutic avenues. PASSAGE is the foundational technology behind their collaboration with Bristol Myers Squibb. And that partnership, which could be worth up to $3.5 billion, is focused on next-generation ex vivo T-cell therapies for cancer.
We hear about CAR T-cell therapy all the time. What technical barrier does PASSAGE break down in that setting that makes it worth billions to a company like BMS?
Well, it really addresses the limits of current cell engineering. Right now, when companies engineer T-cells for cancer, they often use viral vectors to insert the gene, or they rely on random integration.
Which is inefficient and can be dangerous if it lands in the wrong spot.
Yeah. Exactly. It can trigger undesirable effects. BMS wants next-generation T-cells. They need to insert large, complex genetic circuits, the cargo, with extreme precision to make these T-cells more durable and more effective, especially against solid tumors. PASSAGE provides that precision. It gives them site-specific integration of large payloads, something the first-gen methods just can't guarantee.
So Prime isn't just a drug developer.
No, they're a high-value platform licensor to the biggest players in pharma, and that significantly insulates them from the binary risk of their own internal drug programs failing.
And that brings us right to that strategic and, well, painful moment for the company, the strategic pivot in May 2025, a move that arguably tanked the stock, but was absolutely essential for them to survive.
It was a classic bet the farm moment on focus and capital preservation.
Sure.
Before May 2025, Prime was running this enormous, broad, and very capital-intensive pipeline. They're essentially trying to prove the technology worked in every indication at once, which led to a cripplingly high cash burn.
So the pivot was this decisive, leadership-driven move to just abandon that breadth and focus intensely on one specific high-value area.
The in vivo liver strategy.
The market reacted negatively, though. It saw it as a sign of trouble, a failure to manage resources. That's the fallen angel status right there.
For sure. But the goal was clear. Disciplined capital allocation to maximize their cash runway.
By deprioritizing several programs, including one that was already in the clinic.
Right. Their chronic granulomatous disease program, PM359, which, by the way, had already demonstrated success in humans, they cut costs drastically by shelving it. The strategy now centers entirely on using a proprietary universal lipid nanoparticle, or LNP, delivery system to target the liver. The liver is the easiest organ to target with these LNPs, so the path to human data is much shorter.
And the goal is to extend that cash runway, which management now guides will last into 2027. Let me just push back on that a little bit. They shelved PM359, an asset that actually had clinical proof of concept data showing the editor works in humans. Doesn't shelving a validated asset just to save a few quarters of cash, doesn't that look like financial panic, which would, naturally spook the market?
And that is the core conflict the market faced. You're absolutely right to highlight it. Shedding PM359 was financially painful, but it was strategically necessary for them to survive in this environment. It signaled that the company was prioritizing in vivo inside the body indications, which offer far greater commercial scale over the more niche ex vivo cell therapy programs like PM359.
Which require that complex, patient-specific manufacturing.
Right. So it wasn't panic. It was a ruthless shift from proving the science works to achieving commercialization efficiently. The market hated the immediate loss of that clinical milestone, but the new management was arguing that their long-term value was in the efficiency of the LNP-delivered liver pipeline.
Okay, that sets up our deep dive into that focused liver franchise because this is the future of the company. This is where the major catalysts are in 2026. So let's start with PM577 for Wilson's disease.
Wilson's disease is a severe, rare genetic disorder. Patients accumulate toxic levels of copper in their liver, brain, and other organs because of mutations in the ATP7B gene.
And what does the current treatment look like? Why is PM577 actually needed?
So the current standard of care involves what are called chelating agents, drugs that bind to the copper to help remove it, which patients have to take for their entire lives.
Lifelong therapy.
Lifelong. And they have significant side effects, but critically, they're just maintenance therapies. They don't fix the underlying genetic problem, so compliance is tough, and the disease can still progress. PM577 aims for a one-time permanent correction of the most common mutation, offering a potential cure. And the market, while niche, is growing. It's forecast to reach almost $900 million by 2030.
The key to this whole program is the LNP delivery, and we just saw some crucial preclinical data validating that part of it.
Yes, the data they presented at the AASLD meeting in November 2025 was a huge de-risking event for them. PM577 demonstrated successful and sufficient LNP delivery directly to the liver cells in mouse models. But the most important finding was that this led to normalization of hepatic copper levels.
So it proves two things. One, the LNP delivery system works in a living animal.
Correct. And two, the prime editor can actually execute the therapeutic edit at a high enough level to reverse the disease pathology. This is the foundation the whole new strategy rests on.
And that validation points directly toward the next major catalyst for the stock.
It does. The market is now focused squarely on the anticipated IND filing. That's the investigational new drug application, which is expected in the first half of 2026. That move from preclinical work to first-in-human trials will be the moment the market has to start reevaluating the platform's commercial viability.
All right, now let's move to the second liver asset, PM647 for alpha-1 antitrypsin deficiency, or ADTD. This is a much bigger opportunity in terms of market size.
Oh, it's significantly larger. The current augmentation therapy market for AATD, which mostly just addresses the lung symptoms, is already valued at $1.7 billion, and it's projected to almost double by 2034. It's a huge space.
But again, PM647 is addressing the part of the disease that current therapies completely fail to treat. What is that massive unmet need?
The unmet need is the liver disease itself. AATD is really a two-sided coin. You have the lack of the protective protein in the lungs, which augmentation therapy treats, but you also have severe liver cirrhosis caused by the misfolded alpha-1 protein accumulating and just, gumming up the liver cells. That toxic accumulation leads to severe liver disease and eventually the need for transplants. And for that, there's currently no approved therapy. Zero. PM647 targets this toxic gain-of-function aspect directly. It's a huge untapped market.
And this is where the genius of that strategic synergy we touched on earlier becomes really apparent.
This is the single strongest argument for their new focus strategy. PM647 uses the exact same universal liver LNP formulation and manufacturing process as PM577 for Wilson's disease.
So just think about the technical implications of that.
Developing a safe, scalable, and effective LNP is often the single biggest technical failure point in vivo gene therapy development.
So if the Wilson's disease program is successful and shows the LNP is safe and works in humans, That data can be leveraged for the AATD program.
It creates a massive read-through effect. The safety and biodistribution data from PM577 in human trials will substantially de-risk PM647. This dramatically accelerates the regulatory pathway for the second program, it reduces the overall development costs, and it validates their delivery system quickly across multiple high-value indications. The IND for PM647 is expected around mid-2026, building directly on that foundation.
Okay, before we transition to management and financials, we have to talk again about PM359 for chronic granulomatous disease. The asset they put on the shelf. We called it the hidden value shelf.
And it is. This is not a failed program. It already achieved clinical proof of concept data confirming safety and successful engraftment in humans. The company stopped funding it purely for cash preservation, which means the prime editing platform has already been validated to work in a human clinical setting.
So this asset is now a highly valuable, de-risked licensing opportunity.
It is. If a specialized cell therapy player, someone with the capital and the manufacturing capabilities, were to swoop in and license PM359, that upfront payment would be pure non-dilutive upside for Prime.
And it would immediately validate the rest of the platform.
It would. And it solves their cash runway problem without diluting shareholders. It's a high-probability licensing candidate that the current enterprise value gives absolutely zero value to.
Chapter 2, Management Evaluation.
The strategic pivot wasn't just a decision about the pipeline, it was driven by a really decisive leadership transition back in May of 2025. And this fundamentally altered the company's focus, moving it away from pure science exploration.
It was a critical transition. The outgoing CEO, Dr. Keith Gottesdiener, was the classic biotech scientist founder leader. Excellent for early exploration, but
They may be less suited for the ruthless financial discipline needed in a constrained environment. That's what led to that high cash burn.
and his replacement was the former Chief Financial Officer, Dr. Alan Ryan.
And that move just speaks volumes, doesn't it? Dr. Rain has a deep background not just in accounting, but in financial strategy, in healthcare investment banking. His promotion to CEO signals that the corporate priority is now financial discipline and commercial execution.
This isn't a knock on the science. It's just an acknowledgement that cutting-edge tech only survives if it's wrapped in a tight financial package.
Especially when capital markets are tough. It was a clear shift from a science-first focus to a finance-first focus, which was necessary for their long-term viability.
I think that's a really critical distinction for investors to appreciate. I mean, it's easy for a scientist CEO to believe in their own tech, but when a CFO turned CEO puts capital discipline first, it suggests a much harder-edged reality check has been performed.
That's the nuance that really confirms the credibility of this turnaround. And furthermore, they reinforced this commercial focus just recently, in November 2025. They added Matthew Howerluck as Chief Business Officer, or CBO.
And his role is all about deal-making.
Purely deal-making and partnerships. He comes with experience from large organizations like Thermo Fisher. This CBO appointment ensures the company is constantly hunting for those non-dilutive revenue opportunities.
Like licensing PM359 or leveraging Passage further.
Exactly. Anything to protect that cash runway. So the team is now structured for two things: flawless execution of the liver pipeline and maximizing non-dilutive capital.
And it's worth noting, the board still has serious scientific rigor.
Oh yeah. Scientific founder David Liu is still there, and you have the financial muscle of Robert Nelson from Arch Venture Partners. This governance structure assures investors that the new financial discipline won't undermine the scientific rigor that defines the company's moat.
And that internal alignment is one of the strongest signals we'll get to when we talk about the insider buying.
Yeah.
Chapter 3, Financial Health.
Okay, let's analyze the finances. Starting with the Q3 2025 performance, which was reported in early November. And the question was, did the strategic pivot and all that restructuring actually translate into cost savings?
And it did.
It did. It confirmed management's ability to execute on their new mandate. The Q3 results showed clear success in rationalizing costs. The net loss narrowed to about $50.6 million, which, is still high, but it was down from $52.5 million year over year.
And that reduction was a direct result of the workforce reduction and cutting those G&A expenses back in May. It shows the new management is serious about the burn rate.
They are, and they're bringing in small but crucial revenue streams to offset that burn.
Right, the collaboration revenue.
Yeah, it was modest at 1.23 million for the quarter, but those are non-dilutive dollars flowing in from partnerships like BMS and the Cystic Fibrosis Foundation. These small amounts are essential right now. We saw an example of this when they secured an additional 24 million in funding from the CF Foundation in July 2025, specifically to accelerate that program.
Which, again, reduces their reliance on shareholder capital.
Exactly.
Okay, now the cash position. This is the hard floor that really defines the valuation minimum for the entire company.
As of September 30, 2025, Prime Medicine held a solid $227 million in cash, equivalents, and investments. And given there are about 177 million shares outstanding, this translates to roughly $1.28 per share in cash backing.
So when the stock is trading at $3.72, that cash floor offers a margin of safety that a lot of other biotechs just don't have.
It really does. But there's a point of contention here, a discrepancy between management guidance and the current math, and this is where investors need to be critical.
Management is guiding that the cash is sufficient into 2027.
Right. But if you just take the current quarterly burn rate, which is hovering around 50 million, that 227 million only gives you a runway of about 4.5 quarters. And that calculation only takes you into late 2026.
So this is where the risk is. The market might be assuming they're going to need to raise capital in late 2026, which would cause dilution.
That's the fear.
So how does Dr. Reen's financially disciplined team bridge that gap to 2027 without dilution?
It relies entirely on the successful and timely receipt of anticipated non-dilutive milestone payments. The 2027 guidance is a prediction based on expected incoming capital.
Mostly from the BMS partnership.
Almost entirely. Specifically, hitting certain developmental or regulatory milestones for their T-cell programs that trigger tens of millions of dollars in payments. To bridge that $50 to $100 million gap between late 26 and 2027, they have to execute on those milestones.
Or, as we said, find a suitor to license PM359.
That's the other option. Their guidance is really an expression of confidence that they can achieve these external funding triggers.
Let's discuss that BMS collaboration further, because it truly is the financial anchor stabilizing the whole balance sheet and providing that massive optionality.
It is the defining financial transaction that should, mitigate this extreme market pessimism. The deal was set up in late 2024, and it provided $110 million up front.
Which was $55 million in cash and a $55 million equity investment.
Right, at a higher valuation, which de-risked their early cash positions significantly.
But the real value is in the milestone funnel.
Mm.
The potential is just astronomical compared to their current enterprise value.
The milestone potential reaches up to $3.5 billion. $1.4 billion tied to development achievements, $2.1 billion tied to commercialization. And to really put that in perspective for you, the company's entire enterprise value, the value the market assigns to the business minus their cash, is only about $413 million.
So this partnership provides an immense, non-dilutive lottery ticket optionality.
It's worth hundreds of millions of dollars in risk-adjusted value, even when you use incredibly conservative probability estimates. It's a huge asymmetric leverage point.
We've established the technological superiority, the management shift towards financial rigor, and the substantial financial anchor from BMS. It's a setup that clearly argues for a stock price higher than $372.
Right. So the next step is to examine why the market has ignored all these fundamentals and what the smart money is signaling.
Like and subscribe to Stock Analytics AI.
For $4.999 a month, get 500 plus deep dive videos on all S&P 500 stocks, with NASDAQ 100 coming next, plus members only requested deep dives.
Part 2. Chapters 4 to 7. Market sentiment, ownership, risk, and final conclusion. Chapter 4, market sentiment.
So the market narrative around Prime Medicine is really one of a fallen angel. The stock's compression, driven by general skepticism toward pre-revenue biotech and high capital costs, was just severely exacerbated by that restructuring in May 2025.
That restructuring, while fiscally responsible, was interpreted by the broader public market as failure, specifically the failure to sustain a broad pipeline. And that's what led to the stock trading right near its cash floor.
Precisely. Let's look at the numbers again that define this valuation disconnect. The current market cap is about $640 million. When we subtract the $227 million in cash, we're left with an enterprise value of only about $413 million.
Which is a strikingly low valuation.
It is. I mean, to put it simply, the market is assigning negligible value, less than $500 million, to a core technological platform that corrects 90% of pathogenic mutations, is 20 times safer than CRISPR, and comes with a potential $3.5 billion partnership.
The platform itself is basically being treated as if it has no standalone value.
None.
So, if the public market is this pessimistic, is Wall Street equally negative?
Surprisingly, no. The professional investment community is largely bullish. The Wall Street consensus remains broadly supportive. 6 out of 8 covering analysts are maintaining a buy or a moderate buy rating on the stock. They seem to be seeing past the noise of the restructuring.
And the targets reflect that deep-seated optimism. There's a massive implied return there.
Oh yeah, the analyst price targets are high. They're averaging between 628 and 697. Given the current price, that implies a 70 to 90% upside potential. And while some firms like Citi and JMP did adjust their targets lower after the restructuring, they maintain supportive ratings. That signals confidence in the long-term potential of the tech itself.
But the strongest signal often comes from the smart money institutional accumulation. Are the big players buying the narrative, or are they just buying the dips?
They are accumulating heavily, which suggests they're buying the dips based on the fundamental strength of the platform. Q3 2025 data showed significant institutional activity. T. Rowe Price maintained a steady, large position of over 9 million shares. But more tellingly, Cathie Wood's ARK Investment Management substantially increased its stake.
They added over 3 million shares.
Added 3.1 million shares to reach 5.4 million total. Sumitomo Mitsui Trust Group also added over 2 million shares. This signals that sophisticated long-term capital recognizes the current depressed price as an accumulation opportunity tied to those forthcoming 2026 catalysts.
Chapter 5. Ownership Structure.
If market prices are driven by fear, ownership structure is driven by conviction. And there is no clearer signal of conviction than insider buying, especially when the stock is trading right near its cash floor.
So what were the specific details of that insider activity right after the May 2025 pivot? The leadership team essentially bought into their own turnaround plan.
It was highly material. Director Robert Nelson, a really prominent venture capitalist from Arch Venture Partners, purchased over 3 million shares at prices near $3.30.
That's a massive commitment from a board member.
It is. And crucially, the new management team also participated. CEO Alan Rain, the financial steward, he purchased 125,000 shares, and the CTO, Ann Lee, purchased 100,000 shares.
The involvement of Dr. Rain, the CFO turned CEO, is particularly noteworthy there. He's not buying based on abstract scientific hope. He's buying based on his intimate knowledge of the balance sheet, the runway, and the value of that BMS partnership.
Absolutely. When a financial expert who is tasked with capital preservation buys a substantial amount of stock near the per-share cash value, it is the strongest possible validation that the company is undervalued. It tells the market that the internal team believes the strategic pivot is credible and the risk-reward profile is skewed heavily in their favor at these prices.
And this internal confidence is then mirrored by the external accumulation we just discussed with the institutional players.
It just reinforces the whole argument. The fact that major specialized biotech funds, the people whose entire job it is to understand this platform technology risk, are accumulating at the same time. It suggests they agree with the insiders. The core technology and the disciplined, focused strategy are just fundamentally undervalued by the broader market. They're all betting on the 2026 IND filings.
Chapter 6. Risk Assessment.
Okay. We have presented a highly bullish case based on the technology and the strategy, but we have to acknowledge the reality. The research rating is BUY, but it's high-risk speculative value. Biotech investments, especially pre-revenue ones, inherently carry massive volatility and operational risk.
That speculative label is vital. Beyond the standard clinical trial failure risks, Prime Medicine faces some significant macroeconomic and geopolitical risks, and they're tied specifically to their new in vivo strategy and that LNP delivery system.
That's right.
Let's discuss the tariff threat under the aggressive America First policies dominating the geopolitical context in late 2025. How does this directly expose a Boston-based gene editing company?
The exposure is through the specialized supply chain, not necessarily the finished drug product. Prime Medicine's entire future depends on the scalability and safety of their universal lipid nanoparticle system. And manufacturing these LNPs requires highly specialized raw materials, specific lipids, polymers, reagents, which are sourced globally, often from sophisticated manufacturers in Asia.
So aggressive U.S. tariffs, which are sometimes hitting 100% on certain components.
They can rapidly inflate the cost of goods sold, or even worse, cause major supply disruptions. An unexpected tariff hike on a key L&T component could instantly accelerate their cash burn, threatening that whole into 2027 runway.
And that intersects directly with the second operational risk, the changing landscape of the manufacturing organizations, the CDMOs.
Exactly. The U.S.-China decoupling, particularly legislation like the Biosecure Act, is forcing biotech companies to sever ties with major Chinese CDMOs like WuXi AppTec.
And why is that a challenge for Prime?
Because securing a resilient, high-quality manufacturing supply chain is expensive and it's complex. And the shift away from established Chinese partners is creating these huge bottlenecks at Western CDMOs. Prime needs flawless manufacturing of its LNP to ensure consistency and quality for their trials. They have to make sure their supply chain is secure and rapidly scalable.
Which means moving volume to reliable but often more expensive Western partners.
Right, and that transition risks both cost increases and delays.
But this is where their strategic decision to use a single universal LNP formulation across multiple programs becomes a highly effective mitigation strategy, right? They're turning a technical challenge into an operational advantage.
It is the ultimate strategic efficiency play against supply chain risk. By standardizing the LNP formulation across both the Wilson's disease and the ADTD programs, they are consolidating their manufacturing volume. And this concentration of volume gives them much greater leverage with a single, reliable Western manufacturing partner.
Instead of splitting small orders across multiple costly vendors,
They can secure better pricing, guaranteed capacity, and a stronger commitment from one partner. It actively mitigates those specific trade and manufacturing risks. It's a very smart move, clearly led by the financial strategy team.
Chapter 7. Conclusion.
So let's bring this whole story together and reaffirm the core thesis. Prime Medicine is a BUY because the market has fundamentally misjudged the value of the platform relative to its low enterprise value and the clear internal conviction.
Okay, let's quickly summarize the pillars that define this asymmetric opportunity.
First, the technology. Prime Editing is the superior platform. It's confirmed by the 20 times better safety profile and the unmatched versatility to correct 90% of mutations. Second, the strategy. They made a disciplined, board-backed pivot to focus entirely on high-value in vivo liver indications, Wilson's and ATD, using that universal LNP capital discipline.
Third, the validation. You have the $3.5 billion milestone funnel from BMS anchoring the balance sheet, and the preclinical data confirmed that LNP delivery works, de-risking the whole liver franchise.
And finally, the conviction. Massive insider and institutional buying at depressed prices. It confirms that the people who know the science and the financials best are convinced it's undervalued.
All right, let's walk through the sum of the parts, the SOTP valuation, to justify that target price of $7.50.
Yeah.
And let's make sure we use conservative numbers that respect the preclinical risk.
Okay. When we dissect the company's components, the current market cap of $640 million just appears grossly insufficient. We start with the floor. Cash and equivalents, which is $227 million. This is hard cash backing the valuation.
Okay, next, the risk-adjusted value of that huge BMS partnership. How do you responsibly assign a value to a $3.5 billion potential?
You have to be highly conservative. The BMS collaboration targets very early-stage next-gen cell therapies. So we're assigning $175 million to the partnership. That calculation is derived using an extremely conservative 5% probability of success on hitting all those milestones.
Only 5%.
Only 5%. It reflects the high inherent risk, but even with that low probability, the value is substantial.
Then we have to value the core platform IP itself, the prime editing and passage technology.
Right. Even if we ignore all of their internal pipeline programs, the technological moat, the 20 times safer, 90% versatile editing, that commands value. We assign a baseline value of $300 million to the core IP and platform.
And finally, the two lead liver assets, PM577 and PM647, which are nearing those critical IND filings in 2026.
For those, we assign an option value of about $150 million. They're focused on massive unmet needs. So when you tally those four components, the cash, the risk-adjusted BMS deal, the core IP, and the liver assets, We arrive at a total intrinsic value of approximately $852 million.
Compared to the current market cap of $640 million, that yields an implied upside of roughly 33% just to reach this very conservative value. It provides a clear justification for those analyst targets.
The value is locked in the platform. The catalysts are focused on the liver in 2026. Therefore, the research confirms. Initiate coverage with a BUY rating and a 12-month target price of $7.50, dependent on successful execution and those key 2026 IND filings.
Before we wrap up, let's leave you with a provocative thought that brings us back to that shelved asset, PM359 for chronic granulomatous disease.
Right. Remember, PM359 has already delivered clinical proof of concept data confirming safety and successful engraftment in humans. That means, unequivocally, the prime editing system has been validated to work in a human clinical setting.
So the question isn't if the technology works. That's already been proven, but who is going to pay for the next phase of development for that specific indication?
Exactly. For a cash-constrained prime medicine, PM359 is a burden they can't afford to finance. But for a large pharmaceutical company or a specialized cell therapy player, someone with massive manufacturing capacity and clinical infrastructure, it is pure gold. They get a highly de-risked asset with already validated human safety data and a proven mechanism.
So who is the most logical player to acquire or license that proven asset?
And how quickly would that non-dilutive capital push the company past that predicted late 2026 runway and comfortably into that 2027 guidance goal? That licensing deal is the potential hidden trigger that the market has entirely overlooked in its valuation models.
That's a great thought to chew on as the company approaches those crucial 2026 milestones for the liver franchise.
Like and subscribe to Stock Analytics AI.
For $4.99 a month, get 500-plus deep dive videos on all S&P 500 stocks, with NASDAQ 100 coming next, plus members-only requested deep dives.
Thank you for joining us for this deep dive into Prime Medicine, Inc.
And just a reminder that this analysis is based purely on AI research sources available as of November 21, 2025, and is for informational purposes only. It does not constitute financial advice, and biotechnology investments inherently carry a high degree of risk.
Subscribe to stay informed, and we'll catch you on the next deep dive.